In this video, you will learn about label selection, the key to unlocking the power of machine learning in technical analysis. But why this title? Because a lot of attention is given to features or explanatory variables, but generally, we overlook the extreme relevance of labels in the financial markets domain, especially in technical analysis. We will cover how the signal-to-noise ratio determines expectations, the concepts of labeling and meta-labeling, and compare triple-exit labeling with analytical tools labeling. Signal represents useful and predictable information, while noise consists of chaotic and unpredictable data. And unpredictable data is, obviously, non-predictable. Disciplines with a high signal-to-noise ratio involves areas with stable laws such as facial recognition, medical diagnosis, voice recognition, credit card fraud detection, drone operations for solar panel maintenance, and agricultural health. But are automatic trading systems high signal-to-noise ratio models? Unfortunately not. In financial markets, noise is more prevalent, leading to a lower signal-to-noise ratio. Why is this relevant? Because it significantly affects the labels, the target we aim to predict. Look at the image. The targets that directly lead to the creation of automatic, profitable trading systems with no additional tuning and monetization require a level of signal that does not correspond with reality, as is the case in this example, where we try to predict the next day's return of each stock using some technical indicators as features. Our goal in this course is to help you understand the expectations you can have in both technical analysis and the use of machine learning to improve it. With this label, the model will not work because we don't have enough signal. It is not a problem of features. It is not a problem of algorithms. It is a problem of label definition. If we wanted to create a model to detect the quality of olives to separate them into first, second, and third grade, we could expect excellent results. The same applies if we want to detect head and shoulders patterns or candlestick patterns. The model, correctly defined and trained, should automatically detect these patterns with a minimal error level. But if we want labels that allow us to create automatic profit systems just like that, it won't be possible. However, what is possible is to reduce the amount of noise and gain confidence in the prediction to improve the results of that signal-to-noise ratio. Meta-labeling involves analyzing the initial prediction and creating a new label based on the model's confidence in that prediction. For instance, we can get an up signal in our model, regardless of whether it's reached with machine learning or not, and meta-labeling it get the probability of being correct. This way, we refine the prediction further, and we only buy if this probability is above 70. Let's look at a clear example where old technical analysis and machine learning come together. Suppose we have detected a hammer candlestick pattern. Approximately 61% of hammers lead to an upward market reversal, while 39% do not. But why invest in all hammers? Or in other words, are all hammers the same? The answer is no, not all hammers are the same. If we analyze their features from technical indicators to trend length, days in trend, trend slope, shadow length, average real bodies, and many others, we can establish the probability of the hammer working. This probability is what we call meta-label. In the image, according to the probability of the hammer working, we have assigned a category of gold, silver, bronze, standard, or rejected to each hammer using an XGBoost algorithm. XGBoost is an ensemble method that builds a strong model by combining several weaker models. In this case, decision trees. We have improved by 7 percentage points, so by leaving out the rejected hammers, we increase the success rate of hammers from 61% to 68%. We need to be meticulous in defining labels, as they dictate the specific task the algorithm will be trained to perform. Hundreds of labels are possible, and setting them depends on your domain knowledge. Ideally, we should delve deeply into using labels and meta-labels in financial markets, but much work remains to reach that level. Most academic studies overlook this topic, opting for intuitive yet inadequate labels in a discipline with such a low signal-to-noise ratio. Note: the book Financial Markets Labeling is fictitious, but hopefully it will be read someday. Triple exit option. Trading systems often use a triple exit option, including profit-taking levels, stop-loss levels, and fixed time horizons. These systems include specific criteria for entries and exits, considering rules to make trading decisions. Analytical tools. Analytical tools provide useful market information but do not include explicit rules for opening and closing positions. Let's look at an example of a label with a triple exit strategy. We'll consider a very simple case to illustrate the concept. It's important to stress that this example is quite basic, and due to the market's low signal-to-noise ratio, such a simple model cannot generate profits automatically without monitoring. However, it serves to explain the concept of a triple exit label. Suppose we track Apple's price every day, recording the volume, the RSI, and a 21-day moving average, and apply a system with profit-taking, stop-loss, and a 10-day time barrier. A side but important note: moving averages are not used as features in an absolute manner because they depend on the price and require a transformation. You can read the relevant documentation provided just before this lecture, and you will see how we transform them later, in Case 3. For simplification purposes, we will now leave the moving average in its original form. For example, on May 15th, with a closing price of $217.9, volume of 5.8 millions, an RSI at 63.7, and a 21-day moving average of 201.40. We set the triple exit at the closing price. Days pass without the price exceeding the profit, taking level or falling below the stop loss, and eventually 10 days pass and we close the position. We label this exit as time and repeat this process day after day. If we had a highly accurate trained system, on June 6th, when the outcome is unknown, it could predict the label category. With a volume of 3,950,000, 1,234, an RSI of 60.42, and a 21-day moving average of 215.20, it would tell us whether to expect profit-taking, stop-loss, or time exit. These types of labels are very interesting and measurable, making them academically appealing. However, as we've mentioned several times throughout the course, they are not realistic for basic systems without any follow-up. Nonetheless, there are other ways to establish labels that provide valuable information for traders. A labeling system of the analytical tool type could predict whether the market will rise or fall or the probability of a trend change, allowing the trader to decide their strategy, profit-taking, stop-loss, and time frame. Or why not a strategy based on options hedging according to the probability of a trend reversal? With analytical tools labeling, we extract information with models, and the trader decides the strategy, whether in spot trading, hedging, or any other method. In conclusion, effective target labeling is essential for reducing noise and enhancing signal and machine learning models used for technical analysis. Accurate labeling and meta-labeling can significantly improve the performance and confidence of these models.